welcome to the two-part series I'll be doing on liquidity. But firstly, I wanted to apologize for the delay in bringing this series to you. I'm not sure if you can hear it in my voice, but I am still a little bit down with the flu, but I didn't want this to be another excuse or another reason why I didn't put out these videos this week. But I was really out of it the last week and a half with this flu. So giving thanks it's not corona, but was still debilitating. So yeah, looking to get back on track and get back into the rhythm of consistency where posting videos are concerned. All right, so what is liquidity? I think that's the first thing we need to do is to define liquidity. In the forex markets, liquidity is basically wherever money is, wherever volumes of money is, and so in as it relates to forex trading, it'd be wherever traders have their entries. So whatever you would have invested in terms of risk to enter a trade, if 100,000 people entered $1 each on a trade, there's liquidity in the market of $100,000 in terms of the amount of money that it has been put into the market. And that's layman terms, basically what liquidity is. If the banks are trading whatever monies they put into the market to extract profits, that's what liquidity is. So when I refer to the term liquidity, just have that analogy in mind as to what liquidity is. Okay, so all right, to explain to you now, like how do you identify this liquidity and what is the purpose in identifying the liquidity as it relates to your trading? Being able to it's liquidity is the end all and be all of the trading and the charts. It is the reason the markets move. It is the money that moves the markets. And there's no other way to say that, or there's no way to go around that. It is the money that moves the markets. And so if you're able to identify where pools of liquidity are, which is where the banks reach for in terms of retail stops, buy stops, sell stops, so that they're able to enter into their positions, which is why it's said that the banks take our monies, because we're retail traders. Even though we say we're trading like the bank or we're institutional traders, we are retail traders in the grand scheme of things, because all positions don't move the market on a daily basis. Only the banks have the power to do that to actually change the direction of price. No matter how much money we would have invested in the market on a daily basis, it doesn't move the price by even an inch. So we're all retail traders in the grand scheme of things. And so whenever we look to place a trade, if we are saying that we're going to buy, for example, so we're going to be having sell stops, because if you're looking to buy and the trade goes against you, which means that instead of buying, the price is going short, which is selling. And so your stop would come in the form of a sell stop, because you're telling the market to execute, the broker to execute a sell if it is that you're wrong for X amount, which is the amount that you would have risked to enter the trade. And so, for example, if 10,000 people, for example, entered, so for example, that gold was going down. We saw this huge engulfing candle here, and we're saying, okay, yes, we're gonna be selling. And in selling, probably we entered late if we're entering on a lower time frame, like a 5 minute or a 15 minute, but we entered late, and we know that the candles, they move up and down throughout the day. It doesn't just go straight down. There's a lot of manipulation that happens throughout the day with the aim of taking traders out of their positions. to receive the liquidity that's on this side of the banks. And so you enter your trade, 10,000 traders enter $100 each on a trade, right? And so for 10,000 traders that enter $100, that's like $1,000,000. And the banks just see that resting there and sell stock in buy stocks, because this will be buy stocks in this case, because you're selling. They're gonna find a way, as I said before, to collect some of that money that is sitting there. Because yes, they want the market to go down, which is why the market is moving impulsively down. But at the same time, maybe there are not enough buyers for them to be able to sell. And so they have to create the environment for there to be buyers. Where does that come from? The buy stocks that retail traders have in the sales that they have. So it's not that the market isn't going in the direction that you know it's going in, but a lot of maneuvering happens along the way, and a lot of so persons who trade by candles, like each candle that prints on the chart, or if a person trades off trend lines, and it depends. A lot of double tops, double bottoms. It depends on what is printed, which is what we're taught, which is why we're taught the way we're taught initially. Unless you come over to this side where you are aware that when you see certain patterns, it's just a trap, then you will be trapped. And so to get into like how to identify these pools of liquidity so that you can avoid the traps, because that is the purpose of knowing. You avoid the traps. I will fall to a lower time frame to show you. All right, so I'll just draw some lines, and you'll see how the lines will help you to see what's happening. So the trend line, as it's rightly called, it does serve the purpose of showing you trends. And for example, here, oops, all right, let me go on the weekly and show you something, or even the day, well, the weekly is just as fine. Trend line again. So the more touches, the more people sell. Let me fall back to the 1 hour. There was a trend line in here, right here. Let me see if I can find some, and I'll show you what happens each time you see a trend line form in terms of how price is moving. They're very clear. They're not hidden at all. They're very obvious. And when you see things so obvious on the charts, remember I'm telling you it's going to be a trap. And so it is why you need to be patient when you're trading, because it is the patience that really pays. Wait for the manipulation and the traps to be set and for them to fall through. And that's when you look to enter the market, not before or while that is happening. All right, so trying to find some double tops. I think this is one. Then you're always going to see trend lines, because prices is always going to be either going up or down. So you're always going to be seeing trend lines. What else can I show you? So you have the double tops. The same thing happens even when you see price going sideways like this. That's liquidity. And the same thing happens here. That's liquidity. Even though these aren't equal lows, but you have what is called relatively equal lows. So for example, like these two candles here, we would call these relatively equal lows. They're not equal, but close enough to where it's kind of hard to distinguish if they're even not equal. I think these are equal lows, yes. All right, so I'll just draw out a few more examples and then show you what really happens once the liquidity or the pattern is printed and the trap is set. All right, so me, oops, didn't want that yet. All right, can do it here. This is a trend line. This is basically, if I'm to type it out for you, it's basically trend lines, um, double tops. I'll make the words bigger for you to be able to see. Double bottoms, triple tops and bottoms. What other pools are there? I feel like I'm missing something, but it will come. In terms of, all right, let's make this about 20, and you're able to see those. So definitely, when you look out for these, just know that you want to, if you're getting in at the beginning, then it's different. You'll ride the trend down, but try not to get trapped in the end, because what will happen is that price will come back and take out the stops that are in there. And sometimes you really have to check like ranges of price to see what was really happening, because it happens so fast afterwards that you didn't even realize what was happening, and you only realize after the fact. That's one. So in all these cases where you see, so for example, all right, let's get this over here. You saw this trend line, you're always going to find that price will come back and break the trend line. It doesn't always have to come this far down, but obviously there was a change in the trend direction here. But what you'll find is that price will come back and sweep the stops that are under here, which would be sell stops. Because this is how you use this and apply this to help you with your trading. When you see, you think that's how the retail meaning the concept, the person who trades the retail concept. So we say retail traders. When you see the patterns being printed, you think along the lines as to how they would apply this to their trading. And what they would have done is, for each touch they see to the line, they would have bought. And so in buying, they would have had sell stops here. Price didn't move but too far in this case, quickly stopped out. Because probably after two touches, this would have been the entry, and it really didn't move at all. Price took them out immediately. Same thing happened here, where we had the trend going down, but all this movement up now took out the buy side liquidity that was here, because persons would have been selling with each touch of price to the line here. Double bottoms, it's such a great thing for persons who trade the retail concepts, because they're seeing double bottoms and saying, because the M's and the W's tell people they're either to buy or sell. And so the double bottoms in this case tells you to buy. Sell stops would be here. Yes, you get a nice buy. Let me put my cat out. Right, so the double bottoms, they tell you to, from a retail perspective, it's a buy, because they're waiting for the mitigation of this order block. Over here, it's a buy. Depending on how long you're holding your trade for or not realizing what's happening, price will come back and take out these lows. The same thing will happen here. It doesn't have to happen immediately, but price will eventually come back and take these lows, which is why you don't want to take the chance, because you don't know how quickly price will come back for the liquidity resting below these areas. Same thing happens here. The trend line liquidity created here. Price comes up, sweeps that liquidity. It will be the case all the time. The double tops here, prices continues up. Persons would have sold on this second touch here to continue down, to go down, or continue. But price really didn't move down, it just went up. Same thing happened here, taking out over here. And this is what you will see happen every single day, all the time, whenever you see these retail patterns. And these are the reasons why um, these types of ways of trading are taught to us. Because the truth is that the market is manipulated. The algorithm works a certain way. Everything is manipulated for the market makers to win. And so if we're not smart about what we're doing and see things for what they are in terms of these patterns that are printed, then you'll always be caught in the traps. You're wondering why every time you place a trade, you're stopped out and you're not making any progress when you're trading. This is the reason why. A lot of manipulation, a lot of traps, and you just have to be very aware and be able to identify them when they do happen. And this is a simpler part of it. Uh, the next part in this series, though, I'll go over another section of in which you can use liquidity and how you can apply it even further in your trading. I will show you what inducements are because that's an even bigger picture, and you'll be able to see again how you're trapped in your trading by the market makers. Here's another double bottom tool, and maybe yeah, double price came back, took out all the liquidity in here. Yeah, so the next part in this series we'll go over inducements, and you'll be able to see how you can use inducements, having identified that price is creating an inducement, how to use that and to get an entry for your trade. I hope this video was helpful and insightful. And until next time, yeah, be good. Take care. Bye bye.